All right, now this is, let me show you this next example here. Now this is 20 pips is all you need. This is non-compounding, okay? This, say you got a $10,000 account, you want to trade one standard lot for 20 pips a day, and at the end of that week, you want to take that money out. So every week, you're starting with 10 grand again. You're not compounding, all right? Just for pure income, okay? One standard lot, 20 pips, it's 200 bucks a day. That's 1,000 a week. That's 50 grand a year. So with a $10,000 account, you can make a $50,000 a year income, and that's pulling your money out every week. No compounding. Okay, and you can see the chart here. You know, two standard lots, $100,000 a year income. You can trade two lots for 20 pips a day. That's 100 grand a year. Again, that's income. That's not compounding. Once we get into the compounding, you'll see the numbers are astronomical. Okay, you can see if you can get up to 5 standard lots, you know, 5 standard lots takes about, you know, a $50,000 account to do. Or yeah, about a $50,000 account to trade it properly with 2% risk management, and that gives you a $250,000 a year income. So you're making 5 times your trading account per year, okay, with just 20 pips a day. That's it. All right, now this is obviously a perfect world. I mean, you can look at it like 100 pips a week, however you want to break it up. All right, and you're not going to be perfect, but if you're in the ballpark, you're going to be doing just fine. All right, so that's a quick chart on non-compounding. That's purely incomes. If you need income and you've got an account size and you get good at making 20, this is your chart. Okay, but a lot of people are going to want to grow an account. All right, and that's where compounding comes into play. All right, so how much do I risk? How do you know how much do I risk? Okay, first you have to determine what's acceptable for you. All right, now we already saw that initial chart on what 2% drawdown can cause, what 10%. I say between 2 to 4. You know, I say between 2 to 4%. I mean, really 1 to 2% for newbie traders. When you get good and consistent and are making money and are profitable, then you can think about 2 to 4%. But 1 to 2% is where you should really stay. And I've already showed you what that previous chart, in fact, I'll show you, is this one here is based on 2%. So if you don't think that's enough for you, then, well, then we have to rethink it. I mean, we got to, you know, because it's important that you put in perspective how powerful these pips are. Okay, so how much do I risk? You determine that. Say, okay, I'm going to risk 2%. Determine stop loss size. Okay, this is key. I use about a 20 pip stop. I don't want to lose more than 20. So I try to keep my daily performance between minus 20 and plus 20. Just being able to keep it within that range takes some discipline. If you're trading and at the end of a few weeks, you're either between minus 20 and plus 20, even if you're not profitable at first, just the fact that you're keeping it in that range is key. You're not letting it get away from you. Okay, if you can stabilize that and you can be confident in your ability to not lose more than 20, you can have confidence in weighting your account properly. All right, so I use 20 pips as my daily stop loss. I don't want to lose more than 20 a day. So if I don't want to lose 20 pips a day and I don't want to lose more than 2% or 20 pips, then guess what? I make 20 pips equal 2% of my account. And then I calculate my lot size based on my account size. So here we go. 20 pips is 2%. Okay, so once you weight it this way, and I'm going to show you the formula to figure it out. Once you weight 20 pips to equal 2% of your account, you can think about it. That means 10 pips is 1%. So every 10 pips you gain now as a trader, you're getting you're adding 1% to your account. You're saying 1%. I mean, we're talking about in minutes. If you make 15 to 20% in the stock market over the course of a year, you're a superstar. Okay, we're talking about 1% every 10 pips. If you make 100 pips a week, that's 10% a week. Okay, so you have to put this in perspective. Every pip is worth 0.1% of your account now. That means every pip is worth something. Okay, you may think 0.1, that's nothing, but over time, that is a huge amount. All right, let me keep going. I see your question there. I'm working off grids, Baron. I'm guessing you're not one of the Fibonacci grid traders, okay? We use Fibonacci grid, so we're using multiple time frames simultaneously on our trades. So, and I'll give you a link for the 14-day demo at the end here, if for those that are not yet part of the group. Okay, so there you go. We're going to weight our account to 2%. Now we're going to show you how to do that right now. Any questions so far?